Good evening. This is Ken Long from Tortoise Capital with a review of the weekend trading report for December 13th, 2014. Market is in bullish normal conditions on an annual basis with weekly RSI 14. It's at 59 out of 100. On a 10-day basis, using the 10-day NDX, we are oversold with a score of 1 out of 100. Looking at the market mosaic, we are in red bullish with respect to the 200-day moving average at 3.66%. Slope of the 50 has decayed to 0.36. ADX 14 has diminished to 29.5, though still strongly trending. ATR percentage at 0.9 remains under 1. The risk index is the 30-period moving average of the VIX divided by the 10. 1.0 is the reading that is on the threshold between risk on and risk off. Current reading is at 0.89. That puts us into risk off conditions. When you take that score of 0.89, compare it to the last 5,000 trading days, find the standard deviation and the average, we come up with a risk Z score of minus 1.36. This is a 90-day histogram time series of that indicator. You can see that we've pulled down from 3 to worse than minus 1, so that's a 4 standard deviation move here lately, and more room to go. So that says batten down the hatches, protect your gains, respect your stops, be ready for intraday, one-day opportunities in both directions because of the increase in volatility. No change to the blended method of rebalancing. You can see here the current leaders based on close of prices at the close of Friday. ETF2, the theoretical exposure is at 40%. The model portfolio is at 40%. Oops, excuse me. Here's some quick looks at the blended monthly rebalancing portfolios for your reference. And the ETF Max, using the same relative lens, we like things that are green and white as being potentially early in their life cycle. You can see we've got the midterm futures for the VIX, and and the note for that as well, and then and VIIZ is also the VIX related product. This is the S&P 500 through that same BMR lens. Would be looking at Tractor Supply and Whole Foods here in green and white, and Delta and Darden restaurants also green and white. This is the chart of the market's health check. Vertical blue lines are 10, 20, and 30 days worth of look back. The horizontal red lines are support levels that have held in the past and which act as price targets if they get violated on the way down. The dark blue shaded area in the middle is the river. That's the 30-period Bollinger Band plus or minus 1. The lighter shaded blue area is the floodplain. That's the Bollinger Band 30 plus or minus 2. The blue channel is a 10-period regression line, RAF regression channel. You can see prices in the bottom half. The black channel is also a RAF regression channel. This one's 30 days with a 1-day lag, and you can see that we're getting ready to violate the lower support level with any more selling. The red shaded area is the dragon. That is the 10-period Bollinger Band plus or minus a half. That is rolled over from outside the river. That is a sign of potential weakness and previous topping action. So if price on this next move up is rejected at the dragon or before it gets out the top, then that becomes a shorting signal. You can see the 30-period regression line times the slope value of that regression line, the time series. These blue circles indicate where it is, and then the extremes and where it has crossed the zero line. So the slope is still positive, but it has come back quite a long ways, and we're not far from being flat over the last 30 days. We are officially oversold here based on Williams percent R10, and the percent price oscillator continues to open its jaws to the downside. It's useful to note again just how prescient that indicator is, where it started signaling weakness 10 days ago. Here's the ETF regional report. 6 of the 10 indexes, all the globals basically, are on a cash position. That's price with respect to the 4-month moving average. And then also inside the U.S., you can see the sector spiders, energy and now materials starting to suffer. Market health check, everything U.S. is above average. The Nasdaq Tech exceptionally strong. Japan, Asia less Japan below average. All of Europe weak. Only India and Philippines are above the database average. Everything horrible in Latin America and emerging markets. Treasuries and real estate, corporate bonds, gold doing well. Oil still getting shellacked. This is the ETF top 30 using the ETF2 lens. In the Dow 30 through that same lens, you can see Goldman is green and white has started its move back up, as is Pfizer and Disney. And then weakness creeping in here to Microsoft, JP Morgan, and Coca-Cola. ETF liquidity based on 30 days of average daily trading volume. The ones in the green for ATR percentage are the ones that are both exceptionally liquid and exceptionally volatile to make good intraday targets. Shifting to the daily, we got a boatload of channeling, overreaction, 5DD, triple screen, 551Ws, and auto framer candidates to choose from. Half a dozen good frogs in the Dow 30. Some very nice frames here on the auto framer, and you can see a half a dozen also signaling on RSI2. ETF 30, the tactical summary, again, almost half of that set are on auto framer favorable conditions, and combined with RSI2, we have lots of market-based opportunities. Some good frog candidates in there too. Auto framer just with some stats, and the regression line fractals that identify the relative strength leaders and laggards as a function of their the difference between their current price and their 270 regression line price expressed as a function, as a multiple of ATRs. More of the market mosaic. Definitely signs pointing downward. Notice where the 30-period regression line crossed its own 10-period moving average at a distance 2 standard deviations from average. That was the first early warning here. And these are just for your reference. You can stop the tape and review them more closely. This is just how battered Latin America and Cliff and energy have become. Now testing the bottom of the channel in the river. And the 90 has rolled over. The 10 is at the bottom of the sigma channel, and 30 is almost back to average. And that's everything I want to cover from this weekend report. This is Ken Long from Tortoise Capital. Keep your risk measured and powder dry.